Hello, this is Kyle Boston, Vice President of First Coast Financial Group, and I'm bringing you your market watch for the week of September 18th, 2020. What we're going to be looking at this week is the 2020 election. Now, we've had a lot of conversations, and a lot with current clients especially, that come down to the fact that people are really worried about what this upcoming election is going to do to their retirement savings. So what we've done is we've created this report here for you in concert with Brookstone and with BlackRock. And what we're doing is we're taking a step back from the emotions that tend to run really high during election time, and we're looking at historical evidence. Now, to be fair, we have never really seen the same kinds of conditions and factors surrounding this 2020 election in any other election, really. So we don't want to downplay the fact that we are expecting some volatility around election time this year. But here you'll find 8 key observations that we're going to discuss. So generally, many investors think that elections have an outside impact on the market. With elections, again, emotions run really high and they can cloud your investment judgment. So we think the best path is to stick to the evidence. The evidence states that stocks average 10% annual returns over all years and about 11% annual returns in election years. Basically, the presidential election years show no real difference than any other year. However, because of emotions, the presidential election years cause investors to increase the cash allocations in their portfolios. This year, we've seen outflows from stocks and bonds and inflows to money market funds. A very interesting data point is to look at whether there is a divided government, president and Congress, or same party rule. The evidence is that after 3 years, the return of the stock market is 10% annualized in either scenario. The best stock market returns in a presidential term usually happen in year 3. And last year, right on cue, the market scored a big year. The numbers for an incumbent win look a little bit bigger than if a new president was elected. But this is in much fewer observations. The most consistent message here is that in either event, the market puts in a pretty consistent positive return. As far as asset class performance, one thing that stands out is that emerging markets and international markets are historically weak in election years and then put in strong years the following year. Seasonality in election years shows a stronger market in the months leading up to the election, but overall there's not much difference. In summary, taking the emotions out of the investment process and focusing on the evidence suggests that there is no discernible difference between election years and every other year. Hopefully this has given you some peace of mind and some new things to think about heading into the 2020 election. Now, I know we covered a lot of topics here pretty briefly, but if you have any other questions or if you're interested in reviewing your current portfolio or your current risk tolerance, the best way to get in touch with us is through our website, www.firstcoastfinancialgroup.com, or you can give us a call at our office at 904-288-0103. This is Kyle Boston, Vice President, First Coast Financial Group.